My name is Vice President of the UWM Research Foundation down the road. And we have a mentor program called UWM Engage. So if any of you are startups or looking to be a startup and need mentors, contact me. We have a few of our mentors on the panel today, Dave and Mary. And we have David as well joining us today. All of them have been involved in investing. And one of the common topics we get questions about is, how do you do valuation? When do you do it? And what is it really, essentially? So I'd like to, invite them to ask some questions, but you're welcome to jump in, raise your hand, ask questions. But first, I want to start with everyone just giving a little brief intro about themselves. So we'll start with Dave.
Thank you. Good afternoon, everyone. Thanks for coming. Dave Zachman. I've been involved in angel investing for about 15 years. I joined Golden Angels in 2007 when I was still actively working for General Electric. I am a career sales and marketing executive, spent a lot of time, most of my career in medical devices, GE, Marquette Electronics, Masimo. I'm fortunate enough to have been involved in 2 public offerings in my career. I took Marquette public in 1994 and Masimo pulse oximetry in 2006. Started angel investing in 2007.
I'm Mary Hannes. I'm the Associate Director at Golden Angels Investors. We are a angel group here in the Milwaukee area with about 100 investor members and about 50 associate members. And so we invest in startups, obviously, seed stage investing, primarily B2B technologies, and really in the Milwaukee, Wisconsin area, plus kind of what I'll loosely call central US-ish. So I started out as an angel investor about 9 years ago, and then took on this role to help kind of manage the network about 3 years ago. So looking forward to the conversation today.
I'm David Arnstein. I'm a CFO and Managing Director with Venture Investors. And we're an early stage healthcare venture capital fund. We invest in medical devices, pharmaceuticals, diagnostics, and digital health. We worked closely with Mary before on opportunities. We have an office in Milwaukee, in Madison, and in Ann Arbor.
All right. So just jumping in a little bit, like, does everyone here know what valuation is? Or I was wondering, let's start with basics just in case we have people online as well. What is it really, and why do we do it?
Well, in a publicly traded company, it's easy to determine the valuation. You take the number of outstanding shares, multiply it times the price of the shares, and that's what the valuation is, the market capitalization. It's easy. In a company that is a startup that may be pre-revenue, conceptual, what is that company worth? And half a dozen things go into it. I'll let my colleagues weigh in as well, but there's an element of black magic, I think. There's an element of market dynamics. There's an element of founder hubris that goes into what the valuation of a pre-revenue startup is.
So I'll add on to what Dave said, and sort of we can think about valuation in sort of mathematical terms, right? So it's the dollar value you put on the startup, and oftentimes you hear, right, there's the pre-money value and the post-money value. So the pre-money value is before you've raised any funds, and the post-money value is taking that number plus the number of the dollar amount of the funds you raise for your post-money value. And that number helps investors and founders understand, how much, what percentage of ownership a founder is handing over to investors, and how much an investor is going to get in return for an investment. And ultimately, like, you do that math and you get to a percentage of ownership and a share price. So you get sort of a mathematical calculation. That's easy. We all know how to do that. The second piece of it is around, as Dave alluded to, sort of this idea of, well, what's the company worth, right? Particularly early on, where we invest, there's often not a track record of, revenue and sales, and a long track record of that. And there would be a very short track record or none at all if, it's a product that's not going to get to market for maybe several years. So there's an element of trying to understand sort of what is the potential of the company, what are the other factors we can consider around market comparables and what other folks have raised in this, industry or space. And it's ultimately a number that investors can think about to understand, how do I think about this deal? Does this seem like a good deal to me, or does this seem like not a good deal to me? And how do I have that kind of conversation with the founder about how did they land at this valuation and what does it mean? And then what does it mean for an investor to consider investing at that valuation? The second thing I'll say is, at least in our stage, and Dave knows this, we always have to think not about the valuation today, but future valuations. Because typically we're going to put in some money as an angel investor, but we're going to need someone like David down the line to put a much bigger check in to keep the company going and growing. And so what we fashion at the beginning, we have to think about how will someone like David think about that when they start to look at the company for an investment, right? If we have the valuation too high, you know, that may give David heartburn about the next valuation. If we put in some kind of funky, you know, terms and conditions in the term sheet, David may look at that and say, we don't like those things, you know. So we always want to be thinking about who's going to invest next, what will be attractive to them, because if we don't, and the company can't raise funds later, then our investment, you know, probably turns to nothing. So we really have to think about it, you know, with a long-term view and a short-term view when we're making our investment decisions.
Yeah, those are very well said from both Dave and Mary. I think I appreciate Mary's perspective on the future rounds. They said on that. So, you know, I think we look at also kind of Dave saying it's more of an art than a science at the early stage. And, you know, evaluation at the beginning of a company is not like really the most important thing. I think when you go to raise capital, you have to think about the value of your company. But as an investor, you know, if you come in to see an investor and say, you know, my company's worth X and demand something, you know, it's probably gonna turn the investor off, you know. It's important to have an idea of what the expectations are, but it's also important to be realistic and kind of let the market also kind of price your deal too. So as you think about methodologies of how you could think about what your company's worth, you know, it's at the early stage, you know, it's a lot of it's comparables. So find a company maybe similar to yours that's raised capital, see what they were worth. That's a really good way to do it. And then second, Mary's saying, understand back into it. You know, like if you go to a venture capital investor for the Series A or Series B, they're gonna have certain expectations of a return. So you back into it and say, well, you know, if they want to have a 10x potential return on your company, what's that to be worth at the end after 2 or 3 rounds? Like, where do we start with that? So yeah, I think it's not something that should be absolute. You know, it's really just a conversation. It's a bit of a dialogue, and I think it just little advice, not too hung up on like the valuation. You know, it's like you want to make sure it's reasonable, it's sensible, it's fair for everybody, and you set it up for future success. So you avoid some of the stuff Mary talked about, where if you find someone to give you super high valuation, there's a good chance in the future you give an issue raising more capital. So don't get too excited if you find an investor willing to give you some outrageous valuation. It's probably going to hurt you in the end. Just do the right thing and make it sensible and set it up for future success.
All right, so when do you start worrying about this, basically? Like when should you start planning or thinking about value?
Yesterday. I think it's really important for you to start thinking about it from the very early days of your thinking about what you're going to do with your startup. I know that founders that I talk to think of the valuation of the company in terms of the projected valuation. It's always, you know, the positivity of what this is going to be worth. When I really get this going and I get the customers driving, this is worth this much money. So the founder will come with an idea of valuation. It's going to be markedly larger typically than the investor who's looking at the valuation today in real market terms. And if there's, and many of the business we look at are pre-revenue, maybe one customer. So there isn't any data much to base on. So we're going to look at it as a much smaller valuation than the founder is. Thus, you know, to David's point, the art, if you will, as opposed to the science.
I mean, I would just say also, I think, you know, around raising capital is probably in my mind a really important time to, of course, have some expectations in mind and, you know, kind of where that's at. I think that's a good kind of data point to be ready to talk to an investor and have some knowledge about that.
Yeah, I would think about that as one element of, all the pieces you're thinking about for your business, right? So you're thinking about your customers and your product market fit and your product life cycle, and you're thinking about the financial model, that's the underlying engine of your business, right? And the deeper you get into those things and really understand kind of how your business will grow and what kind of investment it will take to grow, right? You want all those pieces to kind of fit together. You don't want to be thinking like, well, today I'm going to think about valuation. And then 3 days from now, I'm going to go work on this supply chain problem I have. And the next I'm going to work on outside. These are all linked up. And so when an investor comes in and talks to you and you're having this dialogue around investment opportunity, right? We're talking about all those pieces together. It's not like we just focus on valuation, right? So we want to understand like how all these pieces fit together to arrive at a valuation that makes sense, and how you think about what kind of capital you need now and in the future, and where that capital might come from, right? So you might need some outside capital now. Maybe you get that helps you establish a customer base, and you use that customer revenue to start funding things, right? And really think through all those pieces. Because all of that's going to influence kind of that valuation conversation.
I'd encourage you as founders to start looking at some of the science around valuations. Even though it is more of an art, I think it is a negotiation at the end of the day. And the more prepared you are to negotiate, better negotiating position you'll bring to the table. And by that I mean there are some scientific methodologies to look at valuations, even pre-revenue. There's a mechanism called the Dave Berkus mechanism. Dave Berkus was a founder of a tech startup accelerator on the West Coast in the 90s. And he most recently updated, as far as I know, in 2009. But it's a way to force you to think about facts associated with your business that might help you make a case for why it should be valued at what you think it should be valued at. There's a scorecard methodology as well that gives certain point values. And you can do this on your own. You can find this, you can Google it. Things like the domain expertise of the founders can be scored. The size of the market can be scored, and so on. So the better prepared you are as you go into, if you start raising capital, the better negotiating position.
Are there methodologies that are just bad? I mean, that people tout that they're actually, if you have an innovative, startup come and they say that they use X method, like that's not a good one. Anything like that?
I mean, I think, one, area that could be challenging, if you just got really just crazy projections, this big hockey stick, and we're going to do all these great things in 5 or 6 years, and then you just cut it back and say, oh, I mean, it's a lot that goes into, understanding that and having the confidence that you're going to hit that. So I think that's kind of a tough sell to just basic blowing off the projections that are obviously going to be, are going to be aggressive and so I think that's for me as an investor, we feel value to think on that, at least initially, especially at the early stage. Like if you have a history and you've got growth rates, if you've got profitability, even though that's different, but the early stage, that's just so far off. Things more important, Mary talked about, are like your supply chain, your management team, your market, your regulatory plan, that's what's more important to the company at that point.
I mean, the quick rule of thumb you can use and put yourself in the investor's shoes is, how do I get a 10x return out of this investment? So if you're asking me for $500,000, then I want a 10x return. So for math, so I want a $5 million return in the end, right? So then you can do the math to say, okay, what does that mean? And that's like that. Let's take it up. It's 20% of the company, right? So that means eventually you're going to sell the company, you're giving me back, $5 million.
Yeah.
Sorry. Not enough caffeine today, to do the math, right? And then to sort of say, okay, does that make sense? Where will my revenues be? What might a sales multiple look like? What kind of acquirers might be out there? What are they acquiring companies for? Can you back into and show me, hey, here's how I think I get you a 10x return?
And the dilution most likely on that 20%. So as you raise additional capital, 20% is you're going to put in, we're at 15 or 13 of that, 10. So all those have to, I back into it.
There's a quick kind of,
Right.
set of math you can do to sort of say, hey, is this realistic? What I'm asking for and what I might sell for in the future, is this valuation realistic, or am I kind of way off?
And I did just did some research this week about the panel. So PitchBook is a big database that we subscribe to as a fund. And they did their Q3 valuation report recently. So I just looked at some numbers, just to give some people some perspective on like valuations. I don't know what people think about in their mind of what their company's worth. But the median pre-money valuation as of Q3 22 for C deals is $10.5 million. Now, it's just a median, because many that are higher, many that are lower, but it's not $100 million, you know, it's not 50 million, you know, these are, it's 10 million, that includes a lot of mostly coastal deals. So maybe the Midwest, it's single digit. So just to give you some perspective on an early stage company valuation, and I'm not saying it's what yours is worth, but a median pre-money valuation of 10.5 million around the country. As
You know, those VC deals or angel deals?
VC deals,
Okay.
yeah.
But see,
Seeds, these are seed stage deals, correct, yeah.
There's an angel money, I presume.
Correct, right. And then two other things interesting to think about that I also looked up was, so the median angel deal value as a Q3 of interest, you think about this, was $300,000. That was the median angel size deal. So now you got a sense of like how much kind of we're raising at the median level of angel deal, and then what median seed value was. And then the median seed deal value was $2 million. So as you think about like capital, if you're an angel, maybe it's $300,000 to $500,000 kind of like in your mind. But now I graduate to that seed, maybe I'm looking at $2 million. So just kind of numbers to think about. And this is not like our fund. This is just PitchBook national data that you guys can think about.
Is that 300,000 the complete round, or is that part of the syndication?
That's the round.
Okay.
And you know, and I guess that's the median. So you know, some are gonna be more, some are less, but that's the median number as a Q3.
And then just out of curiosity, did you look at from Q2 our valuations because of the economic environment coming down?
I mean, I was kind of quickly from like, again, this is data from PitchBook. And I'm sure you see it, you know, later stage deals have come down dramatically over the last year.
Like Series A, Series B?
No, I'm talking like growth rounds, like Series C, Series D type valuation. So companies that have revenue that have raised capital at certain run rates, and multiples come down dramatically in the last, you know, 9 months this year, 6 months. The seed and early stage market has been more resilient, so that it has come down, not to the extent as at least that we've seen. There's a little more stability in the early stage market than you saw in the later stage market. So the deals have definitely come down, valuations. And the other thing that's happened too at the early stage market is that deals become a bit more investor friendly terms. So for a while, it was the last year or so, it was much more founder friendly. So certain terms that maybe give investors certain protection, they weren't in the deals over the last year just because of the leverage was more with the companies. And recently it's moved the other way. So now investors have a bit more protection in some of the term sheets that they had before.
Do you think some of those, as a VC, not as an angel, some of those companies that have raised over the last 2 years in those later stages at those higher valuations are going to be in trouble as access to capital is less available and they have those higher valuations?
I mean, they are in trouble.
Okay.
They are in trouble. Yeah. I mean, right now to go out and raise capital is really challenging. And if there's the elite group of companies that can raise capital at anything in any kind of market, and values can go a little bit down. But the group in the middle that raise all this capital at a huge valuation, they have to grow into that valuation, right? So do they have enough cash to grow into it, or are they going to run out of cash before they grow into it? And if they run out of cash before they grow into it, then are they going to have a huge down round, or are they going to be acquired at a low exit, or are they going to go out of business?
So you mentioned down round. Have any of you invested in a down round, and what was the outcome of that? Maybe you can explain what a down round is.
Sure. So, yeah, a down round is when a company has to raise their next set of funds at a lower valuation than the previous raise, essentially, simplest terms. So, yeah, we've seen that in our portfolio where companies had to raise a down round. We've had times where companies have had to raise, some bridge capital to get into the next phase at either a similar or lower valuation. Sometimes we've had companies who are struggling and have done significant down rounds. You know, at that point, you sort of have to almost start from scratch to say, okay, what's going on with the business? You know, what are its prospects now? What are the challenges it faced, and has it think about how to overcome those? I mean, it can be a good deal if you think that the company, you know, can sort of overcome whatever challenges it has, because you get it cheap and you get your shares cheaper. So it can be really good for people who are participating, but certainly the risk dynamics are, you know, challenging at that point in terms of really understanding kind of, you know, will this next set of cash help them achieve what they're trying to achieve. So, and to David's point, even though we initially invested at the early stage, we obviously have a portfolio that's been around for a while. So we have companies in our portfolio who have gone on to raise, you know, several rounds going forward, and you can see them now in their investor reports, you know, struggling or taking longer to raise their next round of funding. You're coming in at lower valuations, and so you see those dynamics kind of trickling in. We see it from slightly different than what David does, because we sort of see it as our portfolio matures. But yeah.
Yeah, you know, I've always seen angel investing more as do a little good, have a little fun, make a little money. I've been doing this for 15 years and don't have return on capital. So it's more do a little good, have a little fun for me. So from a down round perspective, I sometimes, I'm not the wisest investor, so I sometimes, if I've made a commitment and or syndicate, which mitigates my risk with the rest of the people, I tell my wife that I'm not the only one who made a error here. Many other people have also invested in this company, but I feel like if we've made a commitment to this company, to the founders, and we're making a bet by and large on the jockey, not on the horse. So it's the founders and that team that we're making a bet on. If there is a down round, and we typically have a seat on the board, so we're engaged, we know what's going on with the company. If there's a down round, I feel obligated to contribute to that down round because we've made a commitment to this organization. So sometimes that might be making a bet with my heart as opposed to my head, but I certainly.
Yeah, I'll add too, you know, well, we don't have the luxury, you know, that Dave has as fiduciary, you know, to our investors, we are, you know, we don't have the luxury of kind of do good per se. We do good, but we have to return capital, you know, for our investors. But you know, a down round's not always like a quote unquote like a negative term per se, because we have a company that is doing great, and the market just changed a little bit, right? And maybe they shouldn't have been a value as high as they were anyway, but there were certain factors, some certain euphoria in the market that just had that happen. So you kind of like take a down round or lower valuation, but there's still great prospects for the company. And they can raise capital and do great. You have companies that haven't performed and aren't hitting milestones, and maybe it's a pharma company that the data isn't good, or maybe it's a medical device company that, you know, did hit their first FDA approval. It could be things that just, or a company that technology just didn't work, you know. And so those are a little bit different, where you might just say that, you know, the company isn't worth anymore, really what it was, and you have to decide if you still support it or not, or how do you fund it still. Or it could just be companies doing great, but the market changed. So, you know, this depends on the situation, but it's not always just like a real nasty term per se. It just sometimes it just happens in the market that you can't control.
Circling back a little bit, so you talked about pitch book, but can you give a range maybe of the angel investments, like what valuations you are seeing in Wisconsin?
I have some data from Angel Capital Association. It's a little bit dated, but it's just maybe 7 years old. Angel Capital Association is the trade organization that represents angel groups across the US. So they collect data. They got tons of data on investments made. And their data was 6 or 7 years ago that the average post-money valuation, angel seed investment, $2.7 million. And I want to comment, Mary made the point that we're looking at seed investors at a 10x return on investment. And I use that more greater than that. And I use that term with a lot of founders, and I get this kind of look like what seems onerous, you greedy SOBs. But let me explain what happens to that 10x at the early going. So that $2.7 million average post-money valuation in a seed startup, the average successful exit, and most we know are not successful, the average successful exit was at 6 years, not 2 or 3. So if I take that internal rate of return, that's 6 years, the amount of money invested, the amount of money it's sold for, the amount of time that the money is tied up over that time, this ends up being a 3x investment, 20% compounded per year over 6 years. So we know that at the seed stage, we've got to get the 10x investment, because if it is successful, that's going to be crammed down, if you will, or diluted down to something that's really more reasonable, like a 3x investment. Because there will be follow-on rounds and we will get diluted.
One of the things you also brought up on another topic, one of you had mentioned to think about future employees and the option pool. Can you talk more about that? I think that's a topic that comes up in that young startups maybe don't really think about. They just think about like, we're the founders and you're 30 and you're 30 and, you know, like, but sometimes they forget about future employees and how that affects them.
If you made that comment.
Yeah, it's just important when you think about how you incentivize your employees, and it's called the option pool. And typically is a 15% option pool that will kind of like come out of the cap table. And it can be negotiated as to where that kind of comes from. It comes from some founder dilution, it may come from some kind of post-money dilution, but it is something important to think about. So like Jessica said, you know, look at the cap table. You'll have like, if it's an initial cap table, you have maybe the founders on the cap table. And if you bring a little money in, you have the investors, and you have this option pool. You'd be willing to share some of the equity with the investors, with your employees and people at the company. And that, you know, builds a culture. Oftentimes you can't afford to pay market, you know, kind of like salaries or compensation for people. So the incentive is, you know, to get early to start up and get some equity. Hopefully see that grow over time. So just always think about that. And as you raise future rounds, they call it the re-up, so you may have to re-up the option pool. So now the option pool, give it out, and now you make another option pool. And you know, if things are going well and you're creating value with each round, you know, it's less of a dilution, because your stakes worth more each time, hopefully, and everyone's doing well. So really shouldn't anything that should be like contention, but just something to think about, that you need option pools important to think about the cap table.
So do the founders tend to do the valuation themselves, or have you seen founders that hire someone? Would you say that's a waste of money at this stage?
Yeah, I think about, you know, the valuation is a conversation with your investors. All right, it's a negotiation and it's all part of understanding, right, what the business is, where it's going, what its potential is. And because at this early stage, to David's point, right, there's not 5 years of books to go look at it, because they come up with a mathematical CPA approved, you know, audited financial report number, right? So I would say you're going to get more value out of having those conversations with investors who are actually going to write checks than with consultants or others who, you know,
charge you money.
very nice advice, but will charge you money,
Right.
right? I mean, you're going to get it, even for investors who don't invest with you, right? Having those conversations is going to be helpful in terms of the data points you're going to pick up about, you know, what the market looks like, what other investment deal structures have been, what other valuations maybe companies in similar industries or domains are. And so I would really focus, you know, on that and those dialogues. I mean, I think, you know, it's fine if you come in with your own point of view and, you know, some rationale around that as, you know, the starting point, so that, you know, an investor has something to react to.
I agree. I've seen founders hire an investment banker to help them with that due diligence that you can do yourself. The Dave Burke's methodology and a scorecard methodology, you can do it yourself. They charge you a lot of money, and the investor will discount all of that anyway in the first minute that you start.
Yeah, we've done over 80 deals in the history of our fund. Never once invested in a deal that somebody brought us a valuation of a company. So I don't think it's necessary at all. I think it's, it would not be good use of capital.
What are some of the horror stories? I mean, I have some in my industry, but like people who think they just come across and they say, oh, they're worth 12 million already, and it's like they're going after angel investors, you know. Can you tell us or explain to people maybe who aren't familiar, like why is that so bad? And it just sets you up for failure. You kind of already touched upon it, but I definitely experienced it.
Yeah, you know, I think when you're making an investment, right, you're thinking about all the different factors of the investment, and most importantly, to David's point, the jockey, right? So we're investing in the jockey, the team, right? Because whatever's written on a piece of paper is not what's going to happen, right? So you're going to get hit by a global pandemic, right? You're going to get hit by, you know, some supply chain disruption or loss of a key employee, right? Some other path is going to be what takes place versus what happens. So we're always evaluating, like, how will that team react? Like when the tidal wave hits, how will that team react when sales are slow or they're losing key employees or customers or whatever the headwinds may be. And we're trying to uncover through all these various conversations we're having with founders, you know, are they resilient? Are they open to feedback, right? Because you're going to have a board and you're going to have people, you know, with fiduciary responsibility over these investments working with you, right? And so we always want to kind of understand, you know, are the founders open to that coaching they're going to get from the board and other advisors they may have? Are they going to be flexible when those headwinds hit, right, and all those things? And so part of the data points we have on that are just through all the various conversations. And if the data point is, I come in and this is my valuation and I'm stuck here and I'm not going to move, and we don't think that's really the right place to land, then, you know, that tells you a lot about, you know, the founder and they're working. So I think you just got to think about the evaluation process as a dialogue and as a, to David's point, right? It should be fair then. It shouldn't feel like you got cheated, because you're going to be stuck with these investors for 5, 7, 10 years, right? And same with us. Like we look at this and say, do we want to work with this founder for the next, you know, 5 to 10 years, most likely? And so, you know, it's a little bit like dating, right? So you're like, is this going to work out? Do we have confidence in this person? And do we think they're going to be able to lead the company, but also work well with investors and other constituencies? And so that is a big piece of how we think about that valuation discussion and the data points.
I don't think, and I'm curious, David, we golden angles or you have ever made an investment in an individual as opposed to.
Yes.
Have we? Yes, but it would be unusual.
Yeah, that would be it.
I think by and large, we're betting on it. There's a great argument. Yes, Mr. Would you agree?
Yeah, I mean, there are times where we're like investing like maybe like a new technology and a professor has technology, right? But typically this is not just only the professor, still other people, you know, involved, but it could be real early, it could be a professor, maybe one other person. Yeah, it could be real early at that point.
Your point about option pools earlier, there's the Harvard Business Review article I was going to mention is, do you want to be rich or do you want to be king? And the emphasis on the article is that you can be the king, you can make all the decisions yourself, you can be a solopreneur and do that, but you'll never be as wealthy and as much value as you could be if you surrounded yourself with people who complement you, who fill gaps in your own personal expertise, and you were able to grow more effectively. Thus the need for an option pool. Why I want to see an option pool, because I know that founder is not going to be this on their own. There's technology risk to be assessed for sure. I see most of the failures that I've made as execution risk, that the founder was not coachable and they could not execute. It's not that it was a bad idea, they just couldn't get the job.
Yeah, the other thing to think about too, just like horror stories to think about is, you know, is the investing agreement. Is you've seen agreements that come across that just aren't workable for us to invest in. I think the lesson there is if you're a young company, work with counsel that's got experience in venture capital. You know, don't, you know, if you have a real estate attorney who knows real estate well, I wouldn't be allowed to use that person because I know them well and I work with them, find somebody who knows the industry, they're complex terms, understands it, and also don't repaint the wheel. The NVCA, the National Venture Capital Association, they've got standard documents on their website. Use standard documents. Go to Elaine, does you go to someone like us that we can work within those terms and not have that squash a deal. So make sure that you get going, work with the right counsel and use standard documents and standard terms.
And yeah, we have not done deals, not because of the valuation, but because of other terms in the term sheet that we could not negotiate or remove. We have done a deal where we had to go back, and because we knew that we wanted, that there were venture capital funds that would have to be engaged later on, and there were some terms that we knew was not palatable to them, so we got to go back and renegotiate those and get them out, because we knew no way they're gonna raise the next round with those terms. So yeah, the importance of legal counsel is important, and to Dave's point, someone who's done this, who's worked in this, because they're gonna know all those pitfalls and they're gonna save you a ton of time and headache. Like you need counsel as to what's palatable for customers, and not in a way that disadvantages you, but that to them is kind of standard in the industry.
Back to your point about the key you're doing, both at the angel stage and the later stage. To what extent do you look at the non-controlled seat on the board versus majority share? Or how much does that play into your decision whether or not to invest or how valuable this?
It falls back, I think, Brian, this is to Mary's point about coachability. If the entrepreneur, the founder that we want to do is not coachable, to me, that's kind of a non-starter right there. We require a board, and typically it's a 5-person board. Correct me if I'm wrong, as general, like to see a 5-person board where the investors get 2 seats. The founder is one of those individuals, and the founder picks 2 other. That's reasonably fair. The founder's got 3 votes initially, the investors have 2. The founder has a bit of a leg up, but there are voting rights in the bylaws for that group. So,
Does it track that you're looking at about 40% share of that as well, or you said board seats by?
I would say, no, angel world, we're looking at 20 to 25.
Yeah, I mean, Brian, the venture cap, I mean, like, I can think of one company out of 8 offhand that we control more than 50%. I mean, so it's not a ownership control. Typically, like at exit, we're much less than 20% ownership of the company. It's more about the board rights as an investor. That's where, and control, I mean, you said, control can be kind of in 2 different ways, but it's really not control, it's about the right governance. For the company, having the right to know that, like, with the different voting, different share classes, different directors that arrive at the right decision for the company. And that's done through the board and through the voting rights, not through like ownership percentage. I think that's pretty generally accepted, right? Venture capital. It's not, private equity is a little different. Private equity from a 5 company, won't have the company, or buy out by themselves and leverage it. And, venture capital is very different.
We always want to understand when we're investing. Typically, the board is being formed with we're investing, right, as part of that transaction. So we want to understand composition of the board, who's taking the board seats. Typically, our lead investor will have the board seat. We will talk to them, not us, which 4 out of 5 times we're not the lead investor. So we want to talk to that lead investor who's often going to have the board seat and find out. 1, talk about the diligence they did in the company and why they're investing, and then 2, how they view the board and how they're going to fill the seats and how they're a lot of conversation with the founder about outside directors, how they're going to bring particular skill sets onto the board to round out the experience of the founder themselves or the other board members. We really want to understand, to Dave's point, what's this governance model going to look like, and what are the voices that are going to be at the table one, as fiduciaries of the organization, and two, as providing feedback to the founder and the management team.
Yeah, I mean, I think a well-working board, is a huge component to the company's success. We've seen the boards work well together, they work well with the founder, they're transparent, they communicate well. Then those companies you see doing well and growing and expanding the team, and other ones you can see where the situation with boards that work well together, where the founder isn't cooperative, there's a transparency, and those are challenging situations. So the boards are really important component of the company.
And to echo what you just said, what you don't realize as a founder of a small startup company is that you don't have big management. So to a certain extent, your board becomes your executive management. So the first phone call that you make on a lot of things, the board member, you get their advice, but you don't have an executive vice president strategy. So that's really true. And I'm curious, there was a follow-up. When you serve on boards as an investor, there's the potential, your responsibility from a fiduciary standpoint is all shareholders of that company. Where at the same time, as an investor, when you're negotiating the next round, you're looking out for how do you deal or set that aside or sleep at night? The question here is because of that inherent conflict. I've had investors who, quite frankly, have been on my board where I've had challenges in terms of who they're looking out for. Transactions. Any thoughts, or we never run into them?
So I'll say that's why it's extremely important to think about who you put on that board. So in our case, as an angel board, you will typically look like within our member ranks potentially, so we have 100 investors. Not always, though, because if we don't feel like we have the right person, we might tap into our extended network to find the right person for that seat. And so that's really critical that individual understands what their responsibilities are on the board. In fact, we I always recommend that. Founders have good counsel. It's really good that we all have good counsel, because our counsel does board training. They can train our members on what does it mean to be on a board, because most folks have not been on a board. It has very particular responsibilities, and to your point, it's to represent all of the shareholders, not just our particular interests. And so we're very careful. Often, we want the feedback from our board member about how things are going and sort of what they can share with us, but we are always careful about not asking them to, not putting them in an uncomfortable position where they feel like, well, gee, I need to answer to Golden Angels and not all the show, and that is tricky. So you just have to be really top of it, like I said, you have to select the right person who you think can exercise good judgment and
I agree that the board is absolutely critical. The composition of the board is important. My predilection is not to put people on a board that have expertise that I can hire. So attorneys and accountants don't necessarily go on the board. What I'm looking for is somebody who would augment the founder in terms of their weaknesses, looking at the three main functions of a business. Sales and marketing is an important function. Operations is an important function. Then I see IT, finance, HR as sort of a combined function. So if the founder has an expertise in one of those, great, I want to fill the other two areas with board members that are not necessarily CEOs or attorneys. And where I see weaknesses, that this is my bias, of course, is sales and marketing.
But from the founder standpoint, what sort of successful board members have you seen on the other side? I'm speaking of someone that is today, first board.
don't have that much experience, you may otherwise, but there are people who really have an expertise, who are able to execute, able to coach properly. They're good mentors and advisors, as well as fiduciaries who have domain expertise in their particular area.
I think that's right. I mean, I think, you know, at different stages of the company requires different skill sets too. So if you're just starting out, you know, some people that can help, maybe you've had that experience before. You know, with you have a good like domain experience in your industry, maybe have some success in your industry, may have good contacts in the industry. People who have credibility to the story. People who talk to investors, they see, oh, you know, these people on the board. Maybe they know the person, or their experience is impressive. So I think I look kind of, you know, and then you make another stage where now looking to grow, and you want someone who's had good commercial success, maybe someone who's taken a company public, or you know. But I think at each stage, as you think about your board, maybe you expand it at some point, you know, you get the right people. But early on, you want to get people who can help you at this stage of the company, sure. And really, like Lauren said, to be engaged, be helpful, and you can call them and problem solve and strategize.
Any other questions online, Aaron?
Yes, Doug, we just wanted to make sure we heard correctly that our angel groups typically would be for 20 to 25 state. Did you hear that correctly?
Yeah, so I'll say, okay, it's a rough estimate. It can vary if it's, because obviously it's going to depend on the size of the fund that you use. So, but I would say I'm just thinking about some of the more recent deals are all in probably that 10 to 20-ish range. That's typically then often more than one agent group or any chapter participating in the round. But if you think about just the valuation points and kind of back into the math, just sort of see where that lands. But yeah, I think that's probably pretty fair. I mean, if it's less, then you start to look at the valuation and think it might be a little lofty. Right? If you're coming out with valuation, I'm going to be like, oh, okay, so tell me more about that. You know, at our stage, right? So
Right. It's in the farmer's best interest to get a higher valuation, because then our input is worth less percent of the company. It's in our best interest to get a lower valuation than we have more equity. The typical numbers that our see are looking for $500,000 investment on a $2 million valuation pre-money. That's 2.5 million post-net money, which means we would have a 20% stake. That's not an unusual setup.
Yeah, I can add a little bit to that too, just so PitchBook, they came out in the last report, and they've got going back actually 2012, the graph of amount basically each round that was acquired by an investor. So 2022 through September, the average is 26.4% for angel round. Angel and seed together. Series A was 24.7%. Series B was 17.7%. Series C was 14.6%, and Series D 11.1%. Just give you an idea of kind of think about the model, of how much you're kind of giving up with each round. But it sounds like the numbers are consistent with what Mary gave her sharing, you know, in the 20s, probably the initial amount.
And then Steve Lasuri asked, do investors put value?
Steve's not allowed to ask
You can't ask
questions.
the question,
Oh,
Yes, he can.
do investors put value in a company's formal 409A valuation if they have one?
Never seen one, so I'm.
No, yeah, I mean, a lot of our companies have them, like, typically not.
What is it?
So the 409A valuation is the valuation you have to basically for your options in your company.
It's something the IRS has.
Yeah.
They don't always bear a lot of.
It's really a common share price. The lower the better.
Heavily
because-
discounted.
Heavily discounted, yeah, lower the better for employees, so it's probably not a great indicator. It could be a data point, but it's probably not something you rely on solely on.
And I only made that comment because Steve's a member at Golden Angels. You probably just put that question out.
I know Steve too, so.
Yeah, so he's known by all of us.
Corollary question. A technique that some founders use when they're trying to get their first $100,000 is do a convertible notes. How do you view those? And you might sort of describe those for people, because it's a way of kicking the valuation can down the road. How do you feel about, a company that's not a transaction like that? Does it help hurt? You care?
So do you mean before we see the deal that they do?
Yeah, I mean, the first investment they take is in the form of convertible note. It's going to convert it at, 15% discount to the seed round.
I mean, generally, because, you see a lot of that with companies coming out of accelerators, incubators, where they're getting a little bit of cash up front, either through safe or. Unless there's some unusual crazy terms in there, or there's some crazy valuation cap, or something that's a big that's sort of non-standard in those agreements. It's generally not too much of a concern, unless there's some other term that's going to give that investor some other favorization status in the next round, which typically those don't have that. Those are usually pretty black and white.
Yeah, I was agree. I'm glad you brought that up. I think it's a really good way for companies like going for their angel capital. It's called a SAFE commonly. It's a simple agreement for equity. That's what it stands for. And basically, it's really simple. The cost is low for the documents. That's about the money with the attorneys. And it's really just a convertible note that pays some interest. And the next round it converts into. So it allows you to raise some capital. And then you get a discount, like Lauren said, the investor at the next round. So you get an incentive for your early risk, and oftentimes there's a cap on these, so it has to be reasonable, but so at least you are getting rewarded for your early stage investment, and there's a cap. But so as an investor at our fund, as long as they're normal type safe, we have no problem with that. Investing, and we have invested not often, but we did a safe recently, invested in our fund 6. So we don't do them often. We'll invest in a safe once in a while too.
Correct me if I'm wrong, though, the downside of that is you don't get your Wisconsin angel credits until that converts, correct?
That's correct.
So the 25% kicker that you get back from the state does not occur until that's converted over to equity, which is a nice incentive from an angel perspective.
That's correct. Yeah. Good point.
I'm not saying aside, we see them all the time.
I mean, those are valid questions. Other thing I've learned recently is that when you actually exercise an option, at least the option price you can use as this Act 255 tax credit.
Okay.
Just kind of follow up on that. Do you have a cap set? Is that sort of like set?
Yeah, so that was going to be my other point was if you have a convertible note with a cap, or the safe, and the new standard of the safe is a basically like a post money safe, you essentially are doing the same thing you would be doing on an equity round and setting a valuation. So and so it's kind of, it feels like it's less work, but as certainly for us, we always do an equity round. I think we have 2 safes in our portfolio and a handful of convertible notes. Most of those are sort of bridge round and post equity round things. Yeah, so most of our initial investment is in equity rounds. One for the valuation piece, but 2 because there's lots of other investor protections in an equity round that are not available in the other documents, hence they are simpler. Yeah, so at least for us, you end up answering that question if you put a cap or safe anyway. For the most part, and you still then have to think about, oh boy, if the next thing I do is an equity round and this convertible note has a valuation cap of 2 million, is that good? So you end up in the same setup.
Yeah, what it does, one advantage would be if you have a difference of opinion about the valuation, it's a good way to say, okay, well, let's say the bond takes for 10 million. And the angel investor, they say, I think it's for 5, or the seed investor, well, you said the cap is 7.5, it's like, okay, well, you go, we're gonna invest, you go execute. And the market's gonna dictate where it's at, you know, so it's kind of the market price is at 10, well, that cap is 7.5, but market price is at 5, then that's what I'm converting, so that, you know, it kind of puts a little more onus maybe on entrepreneur than the founder to go out there now and execute. When you're ready to raise your next round and see the market price to that. I would caution you though too, if you do safe, not to like do multiple safes. That gets really complicated if you like stack 2 or 3 safes, not be trouble, they all have discounts, they all have different caps. This is like, it's really hard to figure out how it looks afterwards. So I think I've seen recent couple of lows where there are 2 or 3 safes and different caps and different discounts. It gets really hard to do the math on that stuff. So I would probably just do a safe and then try to do that.
We have a couple minutes left.
Sure.
Kyle, did you still have a final question?
If there's time. What advice do you have for telling founders, okay, bring me a comparable set of companies that are similar to yours at this valuation for the same fundraising or equity that you're into? Because a lot of that's private information. You don't know if the other companies that might be on a pitch book or something like that, if they have patents or sales or what their team is, you just, how the heck can you find a comparable company to where you're at accurately, and that you can do it in a matter of a day or two and not just a week-long or month-long search? So what advice have you seen, or what advice can you give that you've seen works for that type of accurate comparison?
It's a good question.
Yeah.
I don't know. Pitch book is.
So we can always pitch book, it's got a lot of data. You know, I think if you know your industry well, you're gonna know a couple of competitors that, you know, are kind of in your space. So if you know who they are, then, you know, try to get that data, if you're somebody you might know, or get to a database of some sort that's available.
Can
Most
you do
likely,
a quick pitch book, or it have to be like a whole year?
you probably, you know, I think you need to subscribe to it. I mean, I think some like schools have access, you know, maybe ways you get into it. And also, it's know the investor that you talk to is getting most likely the same thing. So again, that's why I get to the point of dialogue. You know, you may even go to the investor and say, here's our competitors. You know, I don't have information on what they raised at, but they're gonna go find it. You know, that's gonna be one data point that's out there. And that would be something very transparent, you know, they'll share it. So either identify who they are, or, you know, at a minimum, and then if you get the information. But again, let's go back to the original conversations and I'll wrap it up. Median premium valuation of 10.5 million. Okay, for a seed company, right? You heard kind of the math around this stuff. I think it's single digits, especially in this market. You know, so you kind of already have your sandbox like in a range. It's not 20 million most likely, and it's not 0. Hey, you heard Dave say maybe it's 2 million. So again, you go into it, but don't. Again, I know it's important, but there's so many more important things, I think, for a company to be thinking about the valuation. And as an investor, I would be candid, if that's the thing someone's most worried about, we're probably not going to pass. So you want to be knowledgeable and you want to do diligence, but everything else is much more important. Like your marketing, regulatory strategy, your team, your sales channels, you know, your experience. That's what's really important. And that's going to drive the value. Talking to the investor, that's going to push it a little bit more. So if we're all thinking, oh, it's worth 2 or 3, 4 million. Well, you look at the heart of it, those are the things that really, at least from my perspective.
Do we miss anything super pressing? All right, well, I'm gonna keep on time. There's more events going on today, so thank our panelists.
Yeah, it's pouring outside. Yeah, umbrellas.
Thank you, guys.